So Ken asked me on Sunday if I'd fill in today, and I was feeling a building apprehension a little bit about that. And I've spoken publicly quite a bit, and I've taught, and so it wasn't really that. So I was trying to figure out, okay, why an apprehension about this? You know, I am a planner, and I like to think things through. So only a couple days to prepare, that was part of it. But it made me think of a Tom Hanks character in Saving Private Ryan. And maybe you've seen the movie, don't know, but he's a captain in the Army, I guess, and they've got this special mission, and it's extremely difficult, and it requires all kinds of leadership from him, and he's amazing, you know, how he motivates them, he keeps them together. They don't even want to be doing the mission that they've been given, and he has to make these great decisions along the way, and the whole time his platoon is trying to figure out what did he do before the war, you know, because they weren't military men, they were drafted or whatever else, and so they're guessing, you know, throughout the movie. He was a foreman at some, you know, factory or business owner or something. So finally, near the end, in a part that they needed to know he was human, I guess, he tells them, and he was a school teacher, and so it's kind of deflating a little bit in some ways, but it was perfect timing. But so what I'm getting at is they were looking at him as a guru, like he was an expert, he knew how to do all of this, they could trust his leadership, and there was no doubt he was going to bring them through. And sometimes I think there's a misconception in my world, people looking at financial advisors, investment people, like they're a guru of some sort. They have these secrets that they can, you know, disseminate, and now you can make a lot of money too, and like there's secrets in the stock market and what stocks to pick and that kind of thing. So I think that was my apprehension, feeling like I'm supposed to be a guru. Well, I have to remind myself and my clients, and now you, that I'm not. And my disclaimer, because financial people always like disclaimers, is I'm a baseball coach. I played for nearly 20 years. I coached for 14. And so that's kind of like my fallback. I feel more like a baseball coach than a financial advisor, even though I've been doing it now for 12 years. And I am a certified financial planner. And so I think I can give you some principles, some basic, solid principles that are not secrets, but are often not followed, that have been tested over time in financial planning and investment management. And so I hope to do that for you today. And by the way, any secrets in the financial world, that's called insider trading, and you go to jail for it, like Martha Stewart. So I don't have any of those. I wrote a marketing piece a couple of years ago called "Planning Never Slumps," and it was a play off of the old baseball adage that speed never slumps. And in baseball, if you're not seeing the ball real well, you're not swinging the bat well, if you've got speed, you can beat out a weak grounder and get a base hit that way. You can lay down a bunt. So it never slumps. Speed always is a value. And planning, true financial planning, even if the market slumps, those principles are still of value even in down times and bad times in the market. So, I thought I'd start, one more word on I mentioned my designation, and it's important for people, if they're ever looking for help from a financial professional, you see all those letters after people's names, and there's just a ton of different ones. And I hope it won't offend anyone here, but there are really only two that are advanced degrees, and that is the CFP and then the CFA, which is Certified Financial Analyst. And you'll see people on mutual fund teams that are managing, you know, billions of dollars. They have the CFA, which is much harder to get than the CFP. But all the other ones are more like passing a graduate course, which is good. It's good information. It's valuable, but it's not in the same realm. It's not an advanced degree in that field. So, if you ever get to that point. So, a little of my family's financial background, financial history, that I think will help you know where I'm coming from. when I was coaching, it was a small Christian college, so I didn't make much money. And we had some debt, and we were in a small apartment in California. And the school paid for our housing, but it looked like we were going to lose that. And we, and it didn't look like there was any means for me to make more money. But at the same time, Stacy and I wanted to have more children. And we felt like that was something God had given us, and we had 2 at the time. And so we prayed about it and felt like God was saying, go ahead. Don't let finances be the deciding factor for you having more children. And so we did, and she conceived. And an amazing string of events happened after that. The college extended my housing for a year or 2 more. I got a raise. They moved me to a different position along with coaching. So I got more money. And then there was this Pepsi deal that I didn't even know how it came to me. It just fell in my lap. I spoke to a couple little leagues, and they gave me $10,000, which was the amount that we were in debt. And so from that point on, we said, finances will never be a reason to not have more kids. And so if you do that, you might end up with 8, because that's how many we have. Okay, so let's go ahead, and the first slide, just some statistics. And this is probably why Ken thought of asking me, but we all know that money is the root of all evil, right? You've all heard that adage. Anybody know where that comes from?
It's a misquote.
It's a misquote.
It says it's the love of money is the root of all evil.
Nice, very nice. It's the love of money and the root of many evils, so not all evil. I have prizes. There we go. Oh,
Great idea.
So we've all heard that financial issues are at the heart of a lot of marital problems. Some of the statistics there: most people living month to month, not with a lot of savings, even if a $1,500 emergency comes up, don't have the means to pay that. And then retirement. Not a lot of people have done the job planning for, saving for retirement. And another disclaimer is that I'm showing you all this information. I'm a hypocrite. I have not applied all of these principles my whole life. I'm working on it too. I'm better off now than I was 12 years ago, for sure. Okay, next slide, please. God obviously knows that, and Kip didn't do these lousy slides I did, but he knows that money is a big issue, and that's why it's mentioned over 800 times in the Bible. And I just picked out a few verses because I didn't read all 800, but if you go through the verses, it seems like they kind of fall into 2 different themes. And so the first verse, Proverbs, a good man leaves an inheritance to his children's children. So talking about saving and planning, being able to leave an inheritance. In the house of the wise are stores of choice food. Foolish man devours it, so it doesn't save. Luke, for which of you intending to build a tower does not sit down first and count the cost? So again, planning ahead. And then you have a slew of verses talking about not being too concerned about money and not putting too much value on it. And warnings, you cannot serve both God and money. It can often become an idol, for sure, and a place where we put our security, we put our faith there instead of in God. And then Jesus saying how hard it is for a rich man to enter the kingdom of God. I mean, that's a scary verse to hear. And I think it seems like most people that I talk to in the church lean more that way, like kind of a disdain for money, and I'm not going to worry about those things. I'm going to try to put my trust in God, and not really wanting to do the planning, almost feeling like I'm not being religious if I'm planning too much, and there's a danger there. But I think we've leaned more that way. So we have these 2 themes, 2 ends of the spectrum. But do I want the next slide? No. The harshest warning I didn't put up here, or one of the harshest one, was when Jesus was talking, saying his story, the parable of talents, and the version that I copied onto here actually called them bags of gold, which I thought fit pretty well. And you know the story. The master leaves money, gold, with 3 servants. 2 of them do a good job, make more money. He says, "Well done, good and faithful servant." The third one buries it in the ground. And here's what he says to that third. The master replied, "You wicked and lazy servant. You should have put money on deposit with the bankers, so that when I return, I would have received it back with interest. Throw that worthless servant outside into the darkness where there's weeping and gnashing of teeth." There's a lot more going on there that I know, but it's really harsh words about being a good steward and having a responsibility. And I think that's the first principle. And the second is, it was the master's money. It's God's money. It's not ours. And maybe if you just left with that, that would be enough for some of us to live differently if we really live like, hey, this is God's money. It's not really mine. So, what I would like to, I want to give you a whole bunch of financial planning pieces that I think will be valuable to you, but that at the heart of this, I think, is having a balanced view of money, of investments, of saving, where we don't put our trust in it, we don't place too much value on it, but at the same time, we're being good stewards and we're taking care of what we should be taking care of. My goal today is that you would leave with one item that would make you a better steward. So we'll get into that in a second, but I thought I'd start with a few basic investment ideas and principles, just because it's kind of fun too, and I got some more prizes. So, what are stocks? Anyone want to take a shot of defining what stocks are?
Shares in company.
He wanted one of these. It is. It's shares.
I didn't raise my hand.
Shares in a company. So it's ownership. And by the way, on those thumb drives, I put a whole bunch of financial plan things. There's a budget template, organizational tools, some websites, planning. And if anybody else wants that and you don't get one of these, you can send me an email and I'll email them to you. So, stocks are ownership in a company. Okay, so it's not, I won't go there yet. What are bonds? Anybody know what bonds are?
Loans to a company.
One for the government, right?
You've got it. It can be government, but it's loans to a company or to the government entity. So you actually, when you buy a bond, you're actually loaning the money to the corporation or the government, and then they pay you interest on it. So you're a lender when you buy a bond. Okay, good. What's wrong with this statement? I'm conservative. I only invest in mutual funds.
Aren't mutual funds a conglomeration of companies that come together and you purchase kind of like a share in all of those companies?
That's right. So
That's only about 70% right?
well,
Pick her answer.
it's right enough for the. So
Right?
a mutual fund can be anything. Anything can go in. It's just the vehicle. You pay a team of investment people to go out and invest in stocks, bonds, commodities, whatever. So a mutual fund cannot be inherently conservative or aggressive. It's whatever's in that mutual fund. But I have heard that. That's why I put it. I've had people tell me that. Oh, I'm just in mutual funds. I'm really conservative. So, what do people mean when they say stocks are risky? What are other people usually referring to when they're talking about that kind of risk?
They go up and they go down.
That's right. It's the volatility. Okay? So it's mostly the volatility that they are referring to. And I'm going to talk about risk a little later. What's wrong with this question? And I've had this question. How much are your IRAs earning these days? An IRA is an individual retirement account. And people will ask, how much are you paying in your IRAs? Yeah.
An IRA is like invested in a lot of different areas also. It's not like just a percentage like a CD.
That's right. That's right. So it's just the vehicle. So you have 401ks, IRAs, regular accounts, 529 accounts. And then you put whatever, it's like the pot, and you can put whatever ingredients you want. You buy whatever is appropriate for the individual. So an IRA doesn't have a certain interest rate, or they're probably confusing those with CDs or something from the bank. Okay. And then last one here, and it'll go into the next slide. Who said this? Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't pays it. Any guesses?
What was the question?
Who said it?
Who said it?
I thought it was Einstein.
It was Einstein. Would you like to give this to somebody else?
I
Carolyn, is that
George
what you're
Einstein.
You can email me. I only have 2 left. So that's right. That's Einstein. And I when I was looking at quotes, Ken, you might appreciate that 2 famous financial guys, investors, were philosophy majors, Peter Lynch and George Soros. So, yeah. Anyway, the money goes into all realms. All right, so this slide looks really confusing. And part of this slide, I'm going to show you compound interest. That's why I had that quote. But and I'm just barely going to touch on this. All of these squares just represents different areas of the market that you could invest in. So there's real estate, small company stocks, large company stocks, commodities, bonds, cash. Anyway, so you have all these different areas you can invest. And each column is a year, so all the way back to 2003. And if you notice, if you just look at the colors, the same area of the market's not on top every year. It's all over the place. And that's where there's no secrets, okay? I can't tell you what's going to be on top next year. You know, we try to make educated guesses, but nobody knows what's going to be on top. And I didn't bring this slide, but if you look at mutual funds, like the top performing mutual funds, and at the end of the year they come out their statistics and it's the top performer and everybody pours their money into it, and so the next year it's not the top performer, it's never the one that's on top the next year. Anyway, why I'm showing you this is the line in the middle is a combination of all those different asset classes, and it's a lot less volatile. This is what's called asset allocation or diversification. You want to do that with your investment. You don't want all your eggs in one basket, and you get a little smoother ride, and in the end you avoid the big losses. If you can see it on the end, the cumulative, or the last column, the combined column, the gray, 8% return is actually 1% more than the S&P 500, which is the stock market. Okay, so you actually get a better return by being diversified in those 10 years. And the cumulative return over those 10 years, 117%. That's the power of compound interest. So you're up the first year, the next year, the interest you earn is not on your original amount, but on your original amount plus what you made the second year. And it compounds, and over that 10-year period of time, you would have more than doubled your money in that portfolio. Okay, next one. And trying to remember why I put each slide in here, but I only have 3 of these total. So this one is just in terms of giving you confidence to invest. So if you look at, this is the stock market over different periods of time, 1 year, 5 year, 10 year, and 20 year, rolling periods. And as you can see, in a 1 year period of time, there's huge swings. So anywhere from 50%, 51% down to 37%. And that's in the last, since 1950. So that's huge volatility, really scary, make you not want to invest. But you go to 3 years or 5 years, you just move over to every 5-year period, and you barely have a 5-year period where the stock market's been down. It's 2%, it's the most that it's been down over that period of time. And then if you go out 10 and 20, it gets even better. So that's why you don't try to pick individual stocks, why you stick in it for the long term. You just, the confidence knowing, or at least history has shown that if you stay in it, the volatility is less and you get a decent return. And the last one, or the next one. Okay, the only reason I'm showing you this slide is that little tiny blue bar on the very end. And this is showing returns of different asset classes since, or for the last 20 years. So you have REITs and gold and S&P 500. And on the end, it's showing you what the average investor's return was. And they earn less than inflation over the 20-year period of time. That's because this is a measurement of inflows and outflows to mutual funds. And what do individual investors usually do? Market gets bad, they sell. Okay, they get out when prices are low, when you should be buying probably. When things are really good, they're jumping in and prices are high. And so because they keep pulling in and out at the wrong time, their return over that period of time is 2% less than inflation itself.
What's REITs?
That's real estate over that period of time. Real estate investment trusts. Okay, I didn't have time for a slide, and I thought this will give you something you can take home. But these are some of the financial planning things that I wanted to go over that I hope will be of value to you. Did I get enough back there? So, one thing I wanted to mention in kind of evaluating my clients, and I deal with people who have already saved a lot of money, or they're nearing retirement, and so they've accumulated, or they've sold a business, so they already have the savings, and they invest with me not to make their money, their fortune or whatever in the stock market, but just for me to try to grow it conservatively and try to keep them from losing it. But in looking at my clients, I think there are some similarities in them. And one is the fact that they did plan and they did save. They didn't wait around and hope that it happened. Over the years, whether in their business or putting away money monthly, they planned and they saved. And that's how they got to a point where they had a significant savings. And then the other thing is that they valued money. Some of them too much, but they didn't disdain it. And they saw that it was a tool that they needed at some point. And so those are just some really good principles, I think, that we could all apply. And just one other thing that I'd add to that I think is really important, and that you can't save unless you do this, is that you have to know what you spend. And that's one of the hardest things to do. It really is. I've sat down with people for financial planning, and we try to work out, okay, just keep track of your spending. And give them a sheet, a blank sheet like I put on that thumb drive, where they can fill it in. And it's just really difficult to track it, and then it varies each month. And then they forget about real estate taxes being due or whatever else. And so it's hard to know what you spend, but unless you do, it will at least hamper your savings some. It'll also hamper your tithing, I would guess, because you won't feel as good or secure in giving when you're not sure what you're spending. So some of these are geared towards knowing what you spend, the others are geared towards saving. So the first one here, I put save even if you have debt. And I see that as a problem, that a lot of people say, oh, I've got all this debt, I can't put away money towards retirement or anything else. And so what happens is they never put anything in savings. And if you match up 10 years of just paying off your debt, or 10 years of putting some into savings and some towards your debt, in the end you end up with more money if you put some into savings. And part of that's compound interest. If you've invested it as well, it's going to grow. And so don't wait. I think it's a good principle to at least get something going, even if it's small. Emergency savings, it used to be, they said 3 to 6 months that you should try to accumulate 3 to 6 months savings. Now they're saying 6 months to a year after we went through the Great Recession when people were out of work for a lot longer. So that's kind of the first goal, is to get that. If that looks like an astronomical number, don't shoot me on this, but I have had clients that I've told them, your bank will give you an equity line. Open the equity line. You don't have to ever use it, but know that it's there as part of your emergency fund. Isn't that better than having to borrow from somebody else or file for bankruptcy or whatever? If it's available, take that for emergencies. Same with the 401k loans. If you have a 401k, you can borrow up to 50% of what you have in 401k on most of them. And you end up paying yourself back, and the interest is low, you're paying yourself back. So as loans go, it's a pretty good loan. It's one of the best out there. Okay. And go ahead and if you have questions as we go through these, but I want to try to get through them too. And what time are we done? 10 minutes?
Yeah. 5 minutes would be 5 to 6.
Okay.
I'm on there. Yeah.
All right.
Freedom.
IRAs, Roth versus traditional. A Roth IRA is you put in after-tax money, so you don't get any tax credit at all. But now it's sitting in the Roth, and if it grows, you don't pay taxes on the growth, and when you pull it out in retirement, you don't pay taxes on it. If you are young, if you have 10 years or more, a Roth is a good place to put money to try to grow it, especially if you're in a lower tax bracket now and you expect to be in a higher tax bracket later. If you're in a high tax bracket and you need a tax deduction, then fund your traditional IRA. I get that question a lot. I don't know why I put the where to contribute in there, but take the free money. If you have a 401k and your employer matches your contributions, that should be where you're putting your money first. Get the matching portion. Health savings accounts. A lot of people don't know how those work, but they're really a great deal tax-wise. You could put in, if a family can put in a little over $6,000 a year, and it's just like a Roth. It's after-tax money. When you pull it out for medical expenses, it's tax-free. And if you don't use it, you can contribute $6,000 the next year and the next, and you could have $50,000, $100,000 when you retire. It could be used for long-term care or anything else. If you don't use it, you don't lose it. So that's a health savings account. You have to have a high deductible insurance plan though. 529 plans. You see the commercials and they make you feel like, I've got kids, I want them to go to college, I should do that. There's no magic in a 529 plan. Okay. In fact, the investments are limited. You get a little bit of a tax break on the money you put in. It grows tax-free. If you pull it out for college, it's tax-free. But you can use a Roth the same way. You put it in a Roth, anything you put into a Roth IRA, you can pull out without a penalty. You just can't pull out the growth of it. So that's a better way, unless you have a lot of extra money. The Roth is a better way than the 529 to save in college.
That's like the Gerber commercials.
Yep. They are good for grandparents to feel good, and they also are a estate planning tool for people that have money that they want to pass on. Okay. Risk. Just talk a little bit about investments. I mentioned risk tied to stocks. Real risk, when you think about it, is running out of money. And so your purchasing power is the greatest risk. So if you stick your money all in treasuries and CDs, it's actually going to decrease each year because inflation is at 2.5% usually. So you're actually taking on more risk if you need your money to grow by putting it in CDs or in treasuries or something like that. So in some ways, stocks are less risky because you have a better chance of outpacing inflation. Investing versus gambling. I think we think of investments as, you think of the stock market as gambling, and you have day traders, and they seem like they're making money, and most of them probably aren't. But you have to remember and remind yourself in investments that you're owning companies or you're loaning to companies, and they're real, and they make a product, and they hire people, and they grow, and their stock price might go up and down, but you're investing in those companies. So it is truly investing. I'm going to skip down here to know what you spend, because I want to get that in for sure if we run out of time. And I wrote on there, what about Dave Ramsey, because I'm going to say a couple things that he might not agree with. And the first one was about the loans. I haven't studied him deeply, but I know enough to know that he's anti-loans and debt, which maybe we all should be to some degree. Okay, so I'm just trying to figure out where I was going. Know what you spend. Okay. Dave Ramsey's really good, his materials, in helping you to know what you spend and to motivate you to save. And a lot of people, maybe most people, need a lot of discipline in doing that. And so the envelopes with carrying your cash around and only spending your cash, that's what some people need to get on the right track. But it's not for every person. And a credit card, for example, if you pay off your credit card each month, you get points. I get close to $1,000 back every year by using one card for all of our expenses. I just get the cash back. It's also a tracking device. Now I know exactly what I'm spending, and that's important in the whole planning picture. So it's a tool. It can be a tool for you. It's not, absolutely you should not have a credit card. Same thing with, I've seen with some Dave Ramsey type things, families will make a decision it seems almost legalistic, where they get at the end of the month, they're out of money, and they need a milk, and they buy the small milk instead of the gallon because they only have $1 and they need $3 to buy it. But next week they move into the next month and they would have had the $2. So they would have saved money by buying the gallon in the end, but because they're sticking so strictly to it, it's not the best financial decision. Anyway, enough of that, and I'm not sure if we have much time to go on with that, but I think that loans and credit cards can be a tool. It's all about stewardship. It's that balance, and that's the biggest issue. Mint.com, I wrote that down there. You may have seen that if you do TurboTaxes. It's a website that you can punch in all your accounts and information, and it'll track everything, and it'll help you to make a budget. And it'll also send you a lot of advertisements, but it is a good tool in tracking your expenses. So am I pretty much out of time right now?
Yeah, you got like a minute or two to close.
Okay. Down on the last point here on this page, there's a video that's out there that Ray Dalio put on, and if you just Google it, the YouTube video will come up. It's about 30 minutes, and it's simply done, and it's like cartoon characters, and it's kind of enjoyable. I watched it with a couple of my kids, and they enjoyed some of it and got some of it. But it's just a really simplified view of how the economy works and how the whole system keeps going, especially in light of the last 5 years and the amount of money that the government's put into it, and where debt comes into all of that, and the consumer. And I felt like it gave a good explanation where it'll make you feel a little better maybe about where we're at, and that there is some hope out there. And anyway, that would be a good place to go just for some general education on how the economy works in general. So, well, I have some other things here, but I am out of time. I wanted to read one quote just in light of Antioch's budget, finances, and tithing. And it came up. I get this C.S. Lewis daily thing on my email, and it was on this, so I thought I'd read it. It's from Mere Christianity, and he says, "I do not believe one can settle how we ought to give. I'm afraid that the only safe rule is to give more than we can spare. If our charities do not at all pinch or hamper us, I should say that they are too small. For many of us, the great obstacle to charity lies not in our luxurious living or our desire for money, but in fear of insecurity."
Can you send that to me?
That, yeah. And it went right along the line of the balance too, just of, where is our trust? It's not in our money, but at the same time, we need to plan and save so that we can help others as well. So, thanks for listening.